Alright, here we go. Welcome to FX Street. It's 8:31 a.m. Eastern. Today is Wednesday, March 24th, 2010. Welcome back, one and all. Great you could join us. My name is Adam Rosen. I'll be the host for the next 45 minutes or so. Very special thanks to FX Street. We have as usual, a very fun topic to talk about today. We're going to talk about the MACD, Moving Average Convergence Divergence Indicator. Before we get started with the MACD, really briefly, I just want to touch on some news that has crossed the tape over the past few hours. I think it's pretty pertinent to what we're looking at. And this is from Bloomberg.com. Please let me know if you can't see the chart or the website at any time. This is from Bloomberg.com, released just a few hours ago. German business confidence rose more than forecast by economists in March as a weaker euro boosted export prospects, and warmer weather paved the way for a resumption of consumer spending and construction. The IFO Institute in Munich said its business climate index based on a survey of 7,000 executives jumped to 98.1 from 95.2 in February. That was a big jump. That's the highest reading since June of 2008. Economists expected a gain of 95.8, and again, the reading was actually 98.1. And that was after hitting an all-time low of 82.2, a 26-year low actually, the 82.2 March of last year. In addition to that, the IFO Institute also releases their expectations index. The IFO's gauge of the current situation increased to 94.4 from 89.8. That was also better than expected. While an index of executives' expectations rose to 101.9, the highest since June 2007. From 100.9. So the IFO Institute, which is basically the German business confidence, we watch for business confidence in Germany because Germany is by far one of the more influential economies in the Eurozone, which certainly affects the euro. This was much better than expected. Good news in Europe. More good news in Europe. This is also on Bloomberg.com. Europe services and manufacturing. Let me refresh the chart here. Europe's services and manufacturing industries grew at the fastest pace since 2007, and German business confidence jumped as the economy rebounded from a fourth quarter relapse. The composite index based on the survey of Euro area purchasing managers, this is the Purchase Manager Index, by the way, the PMI, in both industries rose to 55.5 in March and 53.7 in February, the London-based market economics said today. That was the highest reading since 2007 in August. And also, of course, the IFO number was much better than expected. So two very good pieces of news coming out of the Eurozone. And if you've watched the charts, the Euro has done very, very little but go down. Why has that occurred? Refreshing our webpage and we'll see why. Well, this is also on Bloomberg.com. The Euro fell to a 10-month low against the dollar after government officials said the European Union may need International Monetary Fund help to bail out Greece. And this is even more news on Bloomberg.com. Fitch Ratings. We know Fitch Ratings. We have Moody's and Fitch and S&P. Fitch Ratings downgraded Portugal's long-term foreign and local currency issuer default ratings from AA negative to AA, or from AA. So from AA to AA negative, or negative AA. Fitch affirmed Portugal's short-term foreign currency rating at F1 and the country ceiling at AAA. So we've had a downgrade in Portugal's long-term foreign and local currency, and we've had news come out of Greece that certainly has not been good, also as the case to a lesser extent in Spain as well. So we have some really good news coming out of the Eurozone, specifically with Germany and the IFO number, yet some not so good news coming out of Portugal in Greece recently, and that has really suppressed the euro. Now, you should see in front of you now a weekly chart. I don't use weekly charts very much, but it seems apropos at the moment. This is a weekly chart of the euro dollar. 133.44 is the current price, and you'll notice that the euro dollar 133.46 at the moment is trading at levels we have not seen since May of 2009, and that is huge. Imagine all those traders out there that bought the euro dollar between May of 2009 and now, which is 11 months or so, well, 10 months. Over the past 10 months, any trader who bought the euro dollar over the past 10 months and still holds that trade open is now all of a sudden losing money. Every single trader out there that sold short the euro dollar over the past 10 months is now making money. And that's why it's so important to really make note of currencies when they break new one-year highs or 1 year lows. This is almost a 1 year higher low, and that certainly is important because that gives the market a chance to really become vertical, go up very fast, or in this case, go down very fast. That's when most of the traders get aligned on one side of the market or another. So the question remains, fundamentally speaking, before we tackle the MACD indicator, which is, by the way, the indicator at the bottom of the chart, why is it that the euro dollar is going down? Well, the dollar, Ed, my previous speaker, our previous speaker over here, mentioned that the dollar is very strong, and he's absolutely correct. The dollar has been incredibly strong. Capital, and we can attribute that to a couple different reasons. One of the reasons, capital tends to move into the lower yielding currencies like the dollar or the yen under times of fear. And well, some analysts, at least those that I've read from Bloomberg.com, have attributed the recent strength in the US dollar to the fact that, well, there's a lot of problems in Greece right now, in the Eurozone. Well, they're not exactly ready to raise interest rates yet. If you had read Bloomberg.com yesterday, there was a little article, didn't get a lot of press, but I happened to catch it. The Federal Reserve Bank of Chicago president, we have these different central bank presidents, Chicago, San Francisco, etc. The Federal Reserve president from Bank of Chicago had made a statement yesterday saying that he did not expect the U.S. to raise rates anytime soon. 6 months is what they mentioned, and he said he would not be surprised to even see the Federal Reserve not raise rates until 2011. Well, the low rates in the U.S., the low rates in Japan certainly attract capital as other currencies seem to go through trouble. Now, you may ask, well, the euro doesn't have very, very high interest rates. That is true. But on a relative basis, the European Central Bank can still cut interest rates further, whereas the Federal Reserve at 0 to 0.25% really cannot. So fundamentally speaking, so far, despite the good news coming out of Germany, despite the good news that we've read this morning, the euro, for whatever reason, fundamentally is still taking the direction to the downside. More traders are aligned to the short side and very few are aligned to the long side. Now, eventually that'll change. How do we discover these trades, technically speaking? Well, one way is the MACD. The MACD, the moving average convergence divergence, is a very simple oscillator. It measures two moving averages of 12 and 26 exponential moving averages over a period of 9 or going back 9 periods. Why do they use 12, 26, and 9? I don't know. However, whoever developed the MACD ages and ages ago determined that those were the best settings. I typically like to use the default settings because, well, for no other reason, I like to see the readings of everybody else. With that said, how could we tell, or how can we tell that the euro dollar is going to make new lows and maybe go a little even further? Well, let's see how this works. Let's plug in for a moment the moving averages. And we'll plug in, as we said before, it was a 12 exponential moving average. That's that yellow line that I just threw in there. I'm going to throw in the 26 moving average. This is 26, and we'll change the line to give it a nice blue color. Okay, so the yellow line at the top of the chart represents a 12 moving average, a 12 exponential moving average. The difference between exponential and simple moving averages, exponential moving averages tend to react a little bit faster to current market conditions, that's all. But very, very close. Well, the yellow line is a short-term moving average, a 12 exponential moving average. The blue line is a 26 exponential moving average. You'll notice while the euro dollar was a nice trend to the upside until we hit very, very significant highs up at 151 November of last year, the yellow line, the 12 exponential moving average, the short-term moving average, was above the 26 or longer-term moving average because in an uptrend, if we count back 12 candlesticks and we take the average closing price of those 12 candlesticks, it's obviously going to be higher than the average closing price of the past 26 candlesticks. That's why in an uptrend, the short-term moving average is above the long-term. You'll notice a change of events occurs when the 12 moving average yellow line crosses below the 26 exponential moving average, noting that the trend has changed. Now we have a new trend to the downside. Now, if we had chosen to sell shorts when the moving averages cross over one another, that occurred January 24th. Unfortunately, that occurred at price levels anywhere between 138 to 142. We certainly missed the top. Exponential moving average, or I should say any moving average crossovers, they tend to occur very late in the game. And if you're waiting for that crossover to occur, you have to assume the fact that we're going to miss a good piece of the move. It doesn't mean that we're going to miss the entire move, but it definitely is going to be a little bit late to the trading signal. In terms of weekly charts, it'll be very, very late. The question is, on our webinar, if MACD is just moving average crossover, what will be the difference? Well, it's a great question. The moving average crossovers that we discussed is very simply a moving average crossover. However, you'll notice that the not the candlesticks, we call them histograms. These are the yellow bars below. The yellow bars, I like to follow the histogram bars. There's also the signal line as well. You'll notice that these changed from pointing up to pointing down around the same period of time that the moving average crossover occurred, right around the same period of time. But that is not the signal that I like to use. And Harley just hit the nail on the head. The 9 signal line is the addition to the MACD. Now again, I like to focus on the histogram bars. The histogram bars, when we're in an uptrend, you'll see the histogram bars tend to make higher highs. In a downtrend, they tend to make lower lows. And that's very conducive of a continuation in the trend. However, you'll notice that eventually what happens over the course of time, the histogram bars continue to make higher highs. We see here, this is on a weekly chart. This is September 20th of 2009. The histogram bar, the level was at 27.19. The number really doesn't matter that much. But 27.08, 27.72, we continue to make higher highs. Eventually, in the midst of this uptrend, the histogram bars start to make lower highs. And actually what happens on a weekly chart, we see the highest high we hit was 31.13. Doesn't matter the number, but the date is important. That's October 18th of 2009. That's the week of October 18th, 2009. Now, the next week, the histogram bars made a lower high. That was the first significant decline in quite a while. That's what we want to pay attention to. That's the week of October 25th, 2009. Let's draw a horizontal or a vertical line, I should say, to mark off exactly when that took place. Notice the red weekly candlestick that occurred during that week. This week, and the euro dollar again hit a high of 150.62, hit a low of 146.81. We actually made a little bit of higher highs, and that is what we're looking for. It's called, and the username I put, if I said that right, Divergence is exactly right. And I'm going to explain exactly what divergence is and what we should look for. The signal line is the red line below. Some traders will use a signal line. I personally do not. I like to use a little bit more of a simplified version of the MACD, and everyone's a little bit different. But I like to use a more simplified version of the MACD, looking for convergence and divergence. Now, convergence with a C is agreement. That's when the market and the MACD continue to make higher highs. If we see over here over the past, year or so, that as the euro dollar continue to make higher highs, the MACD also continue to make higher highs. That agreement or that convergence tells us the market is most likely to continue in that same direction to the upside. However, eventually, notice the histogram bars started making lower highs. And notice, and this is certainly most important here, notice the week of November 22nd, 2009, the euro dollar made a high of 151.44, and that was actually a little bit higher, actually a lot higher, about 80 pips higher than the previous high of 150.62. So, over the course of the next 5 or 6 weeks, the euro dollar actually made a higher high. But notice the position of the MACD. The MACD histogram bar hit a high of, 31.13, and then that was the highest high we saw. And then the subsequent high was a high of 29.12. So the histogram bars made a smaller high, while the actual market, the euro dollar chart, made a higher high. This disagreement, or in other words, this divergence, is what we're looking for in the case of a reversal. Harley says, I have 2 moving averages plus the histogram of my MACD. That's absolutely fine. You'll notice different charting packages tend to use different lines, or different formats. 2 lines and a signal line, 2 lines, a signal line, plus the histogram bars. Years ago, I don't remember which charting package I was using, but I remember using a charting package that only had histogram bars on it for whatever reason. Maybe they're trying to save money. But at any rate, it was at that period of time that I really tried to focus in on the MACD, And because I only had access to the histogram bars, I sort of developed this system. It's not because I don't like the signal line or I don't like the moving averages themselves. It was just because the budget chart package that I was using years ago happened to only have to have histogram bars, but it works to our benefit as well. At any rate, the disagreement or the divergence that occurs when the market makes a little bit of a higher high, these little nuances that most traders would probably miss if you're not really focusing in on that, that was the first real key sign of a reversal. After all, it was the first level of divergence that we saw during this entire uptrend going all the way back to May of 2009. So May, June, July, August, September, October, November, December, uptrend. Euro-dollar on a weekly chart gave us very little reason to doubt this trend and very little reason to suspect a reversal. And you'll notice, and this is more coincidental, but you'll notice during this entire trend to the upside, the 12 exponential moving average, this yellow line, just out of coincidence more than anything else, seemed to contain the market very well. In fact, the market very rarely even dipped below this 12 exponential moving average. How nice would it have been to buy the euro-dollar at 138, hold it until it goes up to 150, being able to capture this entire move, and if I'm not mistaken, probably gain on a carry trade as well. U.S. rates were probably already that low. So it probably would have made a little bit of money on a carry trade. Now, this is a weekly chart, and it's not something that's going to work all the time. So I don't want to, come on the webinar and say, well, we should have known better. It's absolutely not the case because every chart's a little bit different. But I think the real important thing to stress in this is the fact that during this entire trend to the upside, there was no signs of divergence. The histogram bars were making higher highs. The MACD was making higher highs. I normally, for those of you that have tuned into my other webinars, I very rarely use weekly charts or monthly charts. I chose to use a weekly chart just to give you a good idea of the big picture of what the euro-dollar looks like. If you're a short-term trader, a scalper, a day trader, this information, it's not going to help you on the surface, meaning you're not going to look for a weekly chart-based trade. However, taking this into consideration, if now, moving forward, we can identify that the euro-dollar is in a strong trend to the downside, if I'm a day trader, even if I'm a scalper, it would be in my best interest to look for only those trades in the same direction as the long-term trend. In this case, to the downside. We're going to take a look at this downtrend in just a moment. The question is, MACD is good in higher frames, but in small time frames, it's fluctuating. So is the best time frame. Can we use multiple time frames, MACD for smaller trades? It's two excellent questions. And getting back to my previous point, I'll expand a little bit further. If you're a short-term trader, if I'm a scalper, a day trader, weekly charts have very, very little use to me. But then again, they kind of do. Because take this previous uptrend that started arguably May of 2009 through the end of the year. So the last 7 months of 2009. If I was only a day trader, and if someone had come to me and said, you know what, I have some inside information, I mean, nobody obviously knows this. However, I'm just joking around. But if I were to have known that the euro-dollar would accomplish another 1,500 pips in the last 6 months of 2009, if I'm a day trader, it would be in my best interest to only look for day trades to buy the euro-dollar. Because, day trades, we could be right 50% of the time, wrong 50% of the time. But if I would have known that the euro-dollar would have gone up 1,000 pips, or I'll say it this way, if I tell you right now that the euro-dollar in the next 6 months will go down another 1,000 pips, well, I think I would have to be very, very smart to only look for short trades. So to answer your question, if you're a short-term trader, if I'm a scalper, a very short-term type of speculator, I'm not going to use weekly charts to look for the entry. But if I'm looking for a day trade, I still want to make sure that the wind is in my sails, meaning that I'm trading in the same direction as the overall trend in the market. Now, arguably over the past, from beginning of the year, really, December of last year through today, and most likely tomorrow, that the euro-dollar is in a new trend to the downside. How can we identify this? Well, we see the 12 exponential moving average is below the 26 moving average. But more specifically, notice the euro-dollar makes fresh lows. The MACD made fresh lows as well. Euro-dollar fresh lows today that we haven't seen, actually, ironically, since May of last year, when this whole uptrend started. And we see the histogram bars are making fresh lows that we have not also seen since around May, actually a little bit earlier before May of last year. So if I'm a day trader, take the weekly euro dollar charts. If we identify such a strong trend as intact, and it really is a pretty significant trend, if we identify that such a strong trend intact, write it down on a piece of paper and put the piece of paper on the desk next to your keyboard in front of the computer and say to yourself, I'm only going to look for euro dollar short trade. Even if I'm a day trader, I only want to sell short the euro dollar. Now, of course, it's true that day traders, we can catch bounces. The euro dollar goes down 100 pips and we can scalp 10, 15, 20 pips back to the upside, or a day trade for 40 or 50 pips. That is true. Those trades are possible. But for myself, and I'm sure for yourself included as well, we do not have an unlimited amount of capital. We cannot simply be in the market all the time and try to catch every single trade. What we should try to do with a very precious, limited amount of trading capital is to find the highest probability trades. The trades that make most sense fundamentally. Well, we had some really good news coming out of Germany today, but then again, the debt in Portugal is downgraded. There's a lot more issues coming out of Greece. I don't think that's going to be over anytime soon. So fundamentally, and besides the fact that the US dollar, for whatever reason, has been on an absolute tear to the upside, so you put a very strong dollar against a very weak euro, and fundamentally, euro dollar to the short side makes sense. Okay, that's fundamentally. That's good. Now, technically, does it make sense? Well, the long-term weekly chart, imagine how much capital goes through the euro dollar every day. I remember hearing a long time ago that the euro dollar, that currency pair, represents around 50% of all the capital in the foreign exchange market worldwide. I don't know if that's still the case. I mean, there's a lot of other emerging currencies that are starting to make their presence known. But the euro dollar, imagine how many trillions and trillions of dollars goes through the euro dollar currency pair. And the fact that we've made new lows, the fact that there's so much capital behind it, who am I to argue with that? And even for a short trade, I would have to assume, I'd have to bet that the probability is that if I'm going to take 100 trades, 50 to the long side, 50 to the short side, I'm guessing that those 50 short trades are probably going to turn out a lot better than the 50 long trades. And that simply puts the statistics, the probabilities in my favor. Now, question is, how can we use a MACD on a smaller time frame? It's an excellent question. Use a smaller time frame. We can go to, let's go to a 1 hour chart. Let's see if we can make some sense of this. We can use it in the same way. What we want to do, if you're a short-term trader, you want to look for breakdowns of breakouts. That's when the market makes a new low, a new high. Now this is a 1 hour chart, euro dollar right now. The low is 134.62. That was on March 22nd. March 22nd of this year, just a few days ago, euro dollar hit a low. Well, now the euro dollar made a little bit of a new low. Now, this I think is important. If we're a short-term trader and we want to look for breakouts or breakdowns, so there's a lot of little different ingredients we can add to this. But with the MACD, if we're looking for a breakdown, if we want to sell short the moment that the euro dollar makes a new low, make sure two things. The euro dollar makes a new low, and make sure we have convergence. We have agreement. Make sure those histogram bars are making new lows. Notice also the level, I should say, that the histogram bar achieved during the first low. Well, the first low on the histogram bar, let's see if this makes sense. On a 1 hour chart, it does not always occur. Notice over here again, March 22nd, we see the histogram bar hit a value of negative 0.00197. Okay. The moment that the MACD made a second low, it's a little bit more difficult, I'll say, with 1 hour charts because they're a little bit less consistent. However, notice, and all I simply did is I marked vertical lines when the market made a new low. This is the first really convincing new low, this big candlestick on March 24th, last today, about 8 hours ago, I would say. But make sure, even if we don't have the confirmation from the previous histogram bars, meaning the first low, make sure that these histogram bars are making new lows. That's what you want to see. The market makes a new low, histogram bars are making a new low. If we're looking for trades to the upside, histogram bars are making new highs while the market makes a new high. The question is how to use the filter for false signals. Excellent question. Well, if we're looking for short-term trades, we should be very cognizant. We should be very aware of the fact the market tends to break out or breakdown during active periods of the day. What are active periods of the day? The first 2 to 3 hours of every trading session. When do markets open in London? Around 3 a.m. Eastern, more or less. Well, from 3 to 5 a.m. Eastern, that's when the market tends to be most active. U.S. markets open around 9:30 a.m. Eastern in New York. But then again, we have big numbers like durable good orders earlier today, 8:30 a.m. Eastern. Officially, I believe it's like 8:30 a.m. Eastern until around 11 a.m. Eastern. That's when U.S. markets consider to be most active. Asian markets usually open around 7 p.m. Eastern, 7 in the evening in New York, and remain active for the first 2 or 3 hours. If you're looking for the market to break out to new highs and new lows, that requires a lot of capital. That requires a market to really give it a good push. If we're looking for that to occur, we're looking for that to occur during an active period of time. Well, it's 9:12 a.m. right now in New York. Let's count back to see if this breakdown occurred during active market hours. So this is 9, counting back 8, 7, 6, 5, 4, 3, 2, 1. Well, this really didn't help us very much because this breakdown occurred about 2 hours before the market opened. But something kind of ironic or kind of unique with the European session is you'll see sometimes the market will give you a second chance. In this case, it did. Is divergence the same for the MACD, the RSI, CCI, which is reliable? It's a great question. The terms convergence and divergence can be used synonymously with different oscillators, including the RSI. I'm not 1,000,000% familiar with the CCI, so I'll talk about the RSI. But yes, the RSI, however, you're going to notice, actually, let me go to a monthly chart here just to make things a little bit easier. You can notice the RSI, I think, is not going to give us as many valid trading signals as the MACD. Not that the MACD is more valid, but I think that the MACD is going to give you trading signals more often than the RSI will. The RSI, it's not going to give you signals very, very often. Here's a weekly chart of the euro dollar again, and I'm going to erase some of these lines just to make it a little bit easier. Now again, we have the MACD in the center with the moving average at the top. We have the RSI at the bottom. The RSI is relative strength index, for those of you not familiar, and this measures the scale on a scale of 0 to 100. 30 and 70 are considered the outliers. So the RSI, the sell signal officially occurs when we cross above and back below 70. That occurred, let's draw a line here, right about there. Okay, now the MACD, where did we say the actual divergence occurred? The actual MACD divergence occurred a little bit later when the market made a little bit of a new high and the MACD failed to do so. So very interesting here. Based on weekly chart, the RSI gave us a sell signal October 18th. On a weekly chart, November 22nd, about a month and 4 days later, the MACD gave us a trade and a trade signal. Now, the MACD, you'll find the trade signals will occur after the RSI. RSI is usually a little bit faster than the MACD. I think the reason being is because the RSI, it just simply looks for those very outlying extreme conditions that sometimes occur, sometimes don't. The MACD, it has its own benefit. Being late to the trade is not necessarily such a bad thing because the MACD will try to filter out some of those false signals. Some may ask, well, should I use the MACD and the RSI together? Chances are, if it's a false signal, the RSI and the MACD will give you those false signals together. My advice to you, if you're a short-term trader especially, and you're trying to weed out those short-term trades, those false signals, I should say, pay attention. First, note the long-term trend on daily charts I normally use, but in this case, weekly charts certainly are applicable. Focus on the long-term trend based on long-term charts, first of all. Only trade in that direction. They say the trend is your friend. Number two, be very, very aware of what time of the day it is. Meaning, if you're looking for the market or if you anticipate that the market will break out to new highs and new lows, didn't happen today. But most of the time, I think you'll find it happens during those active hours, the first 2 to 3 hours of every trading session. And also, try to find a trade that makes sense. I always like to start, fundamentally speaking, does the trade make sense? The dollar has been very, very strong. Honestly, I cannot find an extremely valid reason why the dollar is so strong, except for the fact the capital recently just happens to be running out of the euro and running out of the British pound and a lot of other currencies, even the yen, which actually had some pretty good news a little bit earlier today. But then again, the stock market in the U.S. has been very, very strong. And I think there's been if I had to struggle for a reason why the dollar's been so strong, I think that maybe those traders that trade the dollar are a little bit relieved passing the healthcare bill that we just had in the U.S. over the past couple of days. I don't know necessarily long term if it's very good for the dollar, but on the short term, we know that markets do not like uncertainty. Markets like certainty. Markets like to go up when we know we have a good idea what's going on. Before the healthcare bill passed, depending on which news, station you had listened to, it was 51% yes, 49% no, or the other, opposite indications. And, I think very few people really had an idea of what this would mean. Ironically, I think it has done so far very well for drug stocks, maybe because of the healthcare bill. Now it will encompass 31 million extra patients out there within the U.S. that will do well for drug companies like Pfizer, et cetera. I really don't know. I'm not that much into the analysis. However, putting all that aside, I think now that the healthcare bill at least is passed, good, bad, or otherwise, it has taken a level of uncertainty out of the market. And now traders are like, well, at least I know the answer. And now I can feel comfortable buying U.S. stocks. And now I can feel comfortable buying the U.S. dollar. Question is, can you mention in points what is your general trading plan, divergence, etc.? Excellent question. Now, this will change long-term, short-term traders. FX Street, please let me know when you'd like me to wrap up, by the way. I know I'm just about out of time. But general trading plan, here's what we can start with. And I'll try to type these in to make it very, very clear. Okay, so number one, I'm going to start with long-term charts. Okay, daily chart, weekly chart, etc. I like daily charts, but weekly charts are just as fine. Note the overall trend, the long-term trend to the upside or long-term trend to the downside. That's first of all. And from that point moving forward, when I know the trend, in the case of the euro-dollar weekly chart, very, very clear. The immediate trend is to the downside. Trend is your friend. I'm only looking for a trade to that extent, only to the downside. Now, from that point moving forward, you're a short-term trader. Let's go to a short-term chart. I'm going to take away the indicators because short-term charts or short-term trading doesn't necessarily involve indicators all the time. Now, short-term charts, 1 hour chart, even though you may be a day trader, I think short-term charts are still very, very valuable. From that point moving forward, I will draw support and resistance levels as follows, connecting significant highs or significant lows. If possible, I try not to trade breakout to breakdowns. I found it's not the healthiest of trading styles in the foreign exchange market. It tends to work better with equities. But you'll notice in a long-term trend to the downside, I want to sell short near the upper end of the range, near resistance. Now, we can also draw, and I forgot to mention this, but we should really draw trend lines first on longer-term charts, and I can do that as well. But I want to trade in the same direction as the trend. I want to mark off horizontal lines, significant highs, significant lows. Why? Oftentimes, our former resistance lines become new supports, former support lines become new resistance, etc. Notice the former support becomes new support. We eventually break down. But start with the long-term charts, daily charts, weekly charts. From that point moving forward, you can move to a short-term chart, but you really want to look for the nice entry. Where was the entry? Oh yeah, it was the Aussie dollar. Let's go to an Aussie dollar. Just to give you an example, I'm going to take away this indicator. This is what I'm looking for. Now, this can very, very easily be a short-term chart, but daily chart happens to give us a great example. Take a look at the highest high daily chart, Aussie dollar, 94.04 on November 16th. Draw a line connecting to the next most significant high. That's 93.29 highs of January 14th. Again, first high, November 16th. Second high, January 14th, daily chart Aussie dollar. Well, the third time the market tests and fails to break above this line is the first opportunity to sell short. Take a look at what happened on March 17th. The Aussie dollar hit exactly a high of 92.50, which was almost exactly at this downtrending resistance level. Quickly turned around to the downside the next day, and now 91.04 seems to continue in that direction to the downside. That is an excellent signal I like to look for. Two tops make resistance, two bottoms make support. The third time, and even support makes sense. The third time the market tests and fails to break below support, tests and fails to break above resistance, that's our entry. This is a daily chart, but look for the same type of situations on shorter term charts as well. They do occur. The trend is your friend. Always stick with the long-term trend, even if you're a short-term trader. It's going to filter out those trades, but that's good because it's going to filter out those losing trades, the trades that you don't want to get involved in. Again, we want to look for the highest probability trade. How reliable is the 5-minute chart? I would say very, very little, if any at all. Do not use 5-minute charts. There's one or two strategies that do require 5-minute charts, but we would use those only upon the receipt of big news. U.S. durable goods were released at 8:30 a.m. Eastern this morning. Let's put a 1-hour, 5-minute chart. And that's what we're looking for, is a very, very big move. I cannot see, doesn't look like a big market reaction. No, not a big market reaction. So there is a use for 5-minute charts, but not in terms of our purposes. So I would say start with a daily chart, start with a weekly chart, identify the long-term trades. From that point moving forward, look for the shorter-term trades to occur on 1-hour charts, 4-hour charts. You're not going to hold the trades forever. So it's not a 1-hour chart does not mean you're going to hold it forever. With that said, I think I'm just about out of time. So what I just absolutely flew by. If you want to contact me directly, please do not hesitate to do so. My web address is www.forexlounge.com. How accurate is the MACD against the stochastics? You'll find slow stochastics are faster than the MACD, and I think faster than the RSI. Slow stochastics are probably the fastest oscillator out there. Then the RSI, then the MACD. The MACD being the slowest of the three. And, the MACD is a little bit late to the game, but I like to say it waits for the right trade. Whereas the slow stochastic, it might take you into make position. With that said, I am officially out of time. However, contact me if you will have any questions. Also, if you'd like to learn more about these indicators, FX Street has a 30-day course under my name. Look for my name under FX Street. They have a 30-day course. We go through the MACD, RSI, and all these other great oscillators, and they're all in the form of short movies. On FX Street's website, please see their calendar because we're back on with much, much more, much later. With that said, we thank you very much for joining us. We wish you a great day. We wish you all profitable trades. And we look forward to seeing you.